There is no carve out. Even if it's in the ordinary course of business and on arm's length basis, if it exceeds 10% of your consolidated turnover or 1,000 crores, whichever is lower, you require approval of the shareholders. That is, if the consolidated turnover is less than 10,000 crores, then 10% of consolidated will become the limit for shareholders' approval. If it is more than 10,000 crores, then 1,000 crores becomes the limit for seeking shareholders' approval. No quorum where? No, again, in case of a listed entity, you're necessarily required to give approval, e-voting and approval through e-voting. So at the meeting, let's assume you've convened a meeting, e-voting has already happened. At the meeting, you don't have quorum. Then you cannot say that it has got passed because that's what the Companies Act says. Okay. In which case, you cannot go ahead with the transaction. So a better thing would be, you would ensure that it is passed through postal ballot. Or if it is the AGM, the AGM getting postponed for want of quorum will definitely lead to a huge furore because you've been holding your AGM every year. It's like your shareholders boycotting you and therefore you don't have quorum. And therefore, if it is an AGM, you will necessarily have quorum. You will have, few small shareholders who always come for the meeting. So that should not be a problem at all. First year, there was a relaxation. Subsequently, it cannot, because 23(4) very clearly states it has to be prior approval. So there's no scope for ratification. You cannot proceed with the transaction unless you've got approval of the shareholders. So what you need to see is who are the related parties with respect to the transaction. So you have the categories of persons who are related parties. They definitely cannot vote. Other than them, how many others are there? And from that group of other than related parties, you need to get more than 50% of the votes. Only then do you actually say that the proposal has gone through, which is actually quite tough because you don't know who they are. And the lay investors, the retail investors in India are not normally the ones who vote. And the shareholding is not really very substantial, but they are larger number. Of course, number is not important. Here it's only by value. So, you need to have more than 50% in value voting in favor. Yeah. No. So actually today what happens is you have the proxy advisory reports and they are, they are the ones who actually do a very detailed analysis, and based on their analysis, few of the large investors cast their votes. So therefore, you need to ensure that you see their policy guidelines, ensure that whatever is required to be complied with fully done. So you actually have two things to take care of. One, from a disclosure perspective, have you disclosed everything that is required to be disclosed as per the provisions of law? Two, does that justify doing what you're doing? Because if it does, then the proxy advisories would recommend in favor. If otherwise it does not, you may have disclosed everything, but the transaction is one which, you could have done with someone else, is what the proxy advisories feel. They will not recommend. They will not give a favorable recommendation. In which case, if it is not a favorable recommendation, the task becomes quite tough. If it is a favorable recommendation, one would be reasonably entitled to presume that you will go through. That does not mean that nobody would oppose, because even the large investors have their own analysis also. But normally the yardstick is if all the proxy advisories have recommended for, then it's fairly okay. Even if one of them says it is not in favor, then there is a that there is a bit of a hurdle which you will need to cross. Absolutely, it is tough. So in audit committee, there is no problem. It's shareholders. No. Board of directors. Audit committee comprises of board of directors. It is chaired by an independent director, and you need to have quorum would mean at least 2 independent directors being present at every meeting of the audit committee. Related party transactions under LODR can only be approved by independent directors. In fact, that's another very interesting point, because under Companies Act, all directors are entitled to the same set of rights and powers. But under LODR, if it's a related party transaction, it says only independent directors on the audit committee can approve. Actually, this can also lead to a dichotomy. You're presuming that non-independent directors will always vote in favor. It is quite possible that the non-independent director, who's a non-executive, non-independent, actually votes against a particular resolution. There's nothing which devars him. Let's assume a situation where you have 5 directors in the audit committee, out of which 3 are independent directors. Remaining 2 are non-independent directors who are non-executive. Meeting quorum, you require at least 2 independent directors. Only then under LODR, I'm referring to LODR here, only if you have 2 independent directors can you have proper quorum at an audit committee. Let's assume out of 5, 2 independent directors, 2 non-independent directors are present at the audit committee meeting. The 2 independent directors vote in favor of a resolution. Unanimously voted in favor, a related party transaction can go through. But then the 2 non-independent directors are not in favor of this particular resolution. They say that we don't approve, and they note their dissent on this resolution. What would you say? Would you say that the resolution is carried? Companies Act, you require simple majority, and you don't have a simple majority. But at the same time, going by LODR provisions, one can say it has been unanimously carried. So that actually brings us to the next question. If only independent directors are entitled to vote, will the other non-independent directors just say that we don't have a right to vote, so we're just going out to have a cup of tea, we'll come back after this item is passed? I would say from a governance perspective, don't look at it literally. From a governance perspective, let all the audit committee members be entitled to vote. For the purpose of LODR, only refer to, in the minutes have 2 sentences. Of course, you will be required to write the second sentence only if there is a dissent. If all of them have unanimously voted in favor, unanimously, you don't have to make a distinction. These 2 independent directors have already voted. So mentioning that the resolution was unanimously passed by all the directors present, all the audit committee members present, is the right thing to do. And while you're auditing, this is a very important point which also needs to be checked as to whether all of them have voted or only the independent directors have voted. Because if it is only the independent directors who have voted, then there may be a vote of dissent which may not be getting reflected. Just check that. These are points which will only come up if there is a dispute later. Until there is a dispute, this point will never come up, because no, it's not an indoor management point at all. It's only a governance point, governance simpliciter. It's nothing to do with the management of the company per se. Going to the point on 23.9 with respect to this disclosure, since transactions between the subsidiaries with other related parties of other companies is also required to be reflected in this particular statement, it actually poses a very big challenge. Today, you have a time period of 15 days after the meeting of the board to file this. After 1st of April 2023, this report, assuming there are no amendments to LODR, this report will be required to be filed on the same day of the meeting of the board to approve the financial results, which means half-yearly results as on 30th September, post the board meeting. Presently, you have 15 days, but from 1st of April, once the financial results for the whole year is approved by the board, the half-year period from 1st of October to 31st of March, the related party transaction report will need to be filed on the same day, which actually poses a huge challenge, not because of the main listed entity. Listed entity, the auditors would have done it. You will have a clear idea as to what the situation is. But with respect to the subsidiaries, while the audit would have happened from the audit report, you will not get under Ind AS transaction between one unlisted company with the related party of another unlisted company does not come under audit at all. That's something which is outside the books that is required to be calculated. And until the audit is completed, the books are not going to be shared. So you will actually have a tough time getting this full collation done and filing it on the same day on which the listed entity approves its accounts. Is going to pose a huge challenge, especially for companies which have large number of subsidiaries. As you may be aware, Tata's earlier had around 300 subsidiaries. They are now merging few of those. But considering, even a small company with 20 subsidiaries, because overseas subsidiaries will also get covered in this, it's going to pose a challenge. Of course, there's a huge opportunity of doing related party audit itself. But having said that, it's going to be quite a Herculean task, because ascertaining as to how many entities are there. I mean, vendor master, you would have plotted these and you would be collating the details, but it's quite a tall task. Coming back to shareholders' approval is only required for related party transactions exceeding the threshold of 10% of the turnover of the entity concerned. Under 188, it's only the turnover of the entity, or 10% of the net worth. With respect to assets, it will be 10% of net worth. With respect to the P&L items, that is sale, purchase of goods, services, as the case may be, it will be 10% of the turnover of the entity concerned. With respect to office or place of profit, there's a very interesting question which comes up. Office or place of profit, there is a threshold limit of 2,50,000 per month, which basically means if you were to annualize it, it is 30 lakhs. Of course, the limit given is in terms of per month limit, which therefore means in any single month, if that limit is exceeded, you require approval. It is not just annualized, but I would say assuming the amount payable per year, per month is consistent, you can comfortably take it as 30 lakhs per annum. Now, if it is 30 lakhs per annum, and if it's in the proviso says if it's in the ordinary course of business and on arm's length basis, you don't require approval of the shareholders. And with respect to a director, the explanation says that if a director receives any amount which is over and above what is entitled to, then it will amount to a case of office or place of profit. Let me throw a question at you. Let's assume a director is paid an amount which is within 5% of the net profits of the company. Under section 197(1), 5% is what the section very clearly says. It says that if it is proposed to pay an amount in excess of 5%, then you require a special resolution. And so therefore, the percentage limit of 5% is what is covered in Schedule 5. So Schedule 5, Section 2, Part 1 very clearly says 5% of net profits calculated up to as per 198 before charging such remuneration will be absolutely fine. But now you actually are permitted to pay this 5%, 10%, 11% are all limits which can all be pushed subject to the approval of the shareholders. 11% can also be increased. 5% can also be increased. There is no specific limit as such. So 5% can be increased. Let's say, for example, all the directors put together, it said 10%, even it says 10% even as per 197, which can also be increased. But having said that, let's assume you were to pass a resolution saying that you want to pay an amount not exceeding 10% of the net profits as remuneration of Mr. A, a director of the company. Now, as per Schedule 5, the limit of 5%, which was earlier there, has also been removed. It says any amount as may be approved by the shareholders. So therefore, shareholders have approved limit of 10%. Now, is this 10% amount which he is entitled to? He's not getting anything over and above what he's entitled to. What he's entitled to is what the shareholders have approved. So the shareholders, once they approve 10%, does it mean that there is no office or place of profit? Which effectively would mean, with respect to a managing director or a whole-time director, the concept of office or place of profit is completely gone. because you're saying anything which is over and above what he is entitled to, which means as remuneration, he is entitled to whatever is approved by the shareholders. Let's say the 11% is increased to 20%. A special resolution is passed by the shareholders for that. Another special resolution is passed by the shareholders approving a limit of, say, 10%. Then he's not getting anything over and above what he's entitled to. So it does not amount to office or place of profit. Technically, this position is correct because Companies Act 2013 197 read with Schedule 5 has got amended effective 2018. So therefore, this is quite right to say that whatever is paid to the managing director or whole-time director, so long as it is with the approval of the shareholders, there is no officer place of profit. However, the term remuneration is defined the way it's defined in Income Tax Act. So therefore, anything which is paid to the managing director, whole-time director, or any other director will amount to remuneration. So if he is paid, let's say, X amount for letting out his flat, that will amount to remuneration. So if he's being paid any amount, he may have given it as a guest house to the company, that will amount to remuneration. In the alternative, you would be treating this as a related party transaction with the director concerned. And since it is a related party transaction, it will require approval of the audit committee as well as of the board. Can you say it is in the ordinary course of business to be entering into such a transaction? I would say it is not in the ordinary course of business, and therefore will also require shareholders' approval. So if it is with the director concerned, you've got to be slightly careful. The only carve out is in section 197, subsection 4, where it says that where a director is paid any amount with respect to something which is rendered by him in his professional capacity, not related to what he is doing as a director, then that will not amount to remuneration. Remuneration will not include any amount which is paid to him for rendering services not connected to his position. Let's say, for example, a director holds a worldwide patent with respect to one particular manufacturing process, which he has been holding for, let's say, the last 20 years. He joins a company in the 18th year of his career, and the company that he joins decides to go into this particular line of business and wants to take a license from him for this patent. And he's willing to offer it to the company at, let's say, 50% of the price that he normally charges all others in the world. This will, of course, be a transaction with a related party requiring audit committee approval, but the amount that he gets from the company will not be treated as remuneration. If he is an independent director, while it will not be treated as remuneration and he'll be entitled to get this money, one will need to see whether he will pass the test of independent director, because under section 149 subsection 6, no matter what the transaction be, if it exceeds 10% of his gross receipts in a year, he loses his independence. So there is this material pecuniary transaction which will also need to be taken care of with respect to an independent director. So one needs to be mindful of what the nature of the transaction is when you are dealing with a related party, and you need to see as to the different aspects which will automatically get attracted, especially if it's an independent director. Any transaction with an independent director, you need to see whether it affects his independence and whether he will then cease to be an independent director because of that. Because any pecuniary transaction, while it will not be a remuneration, it can affect. And also in case of an independent director, he can only get 3 kinds of remuneration. 1, sitting fees for attending the meetings. 2, commission, which is based on profits. 3, reimbursement of expenses for attending the meetings of the board or attending the other meetings as the board may have approved. Other than this, he cannot get anything else. So therefore, one needs to be careful as to how exactly he is getting any other amount. But if he is not an independent director, let's say he is a managing director, as I was mentioning, and he gets this money, it will not be clubbed with his remuneration. From a related party perspective, let us say the company wants to company has, let's say, subsidiaries, and a director is required to devote some time to the time and attention of the subsidiaries, which is not normally required to be done by him, but he does, let's say, for example, prospecting for the company and ensuring that the company's top line is showed up, and he is given X amount as let's say a commission with respect to the transaction. This will also amount to a related party transaction requiring approval of the audit committee. This will, of course, require disclosure in the financial statements, but will this amount to remuneration? Answer is no, because the entity which is paying it is an overseas entity, which is a subsidiary. It will, however, require disclosure in the financial statements that the person has been given remuneration from another subsidiary company, as the case may be. Schedule 5 refers to payment made by any other company, but it does not, the term company does not include a foreign entity, and therefore under Schedule 5, technically this will not require a disclosure. I would say that from a governance perspective, any amount paid to the person, whether from the entity or from any other entity, it is better to disclose, especially in case of a listed company, because it will come in the in the related party transaction statement, which is going to give all the details, because even if it is paid by the overseas entity, it is paid to a related party, and hence the disclosure will be required to be made. In fact, the related party disclosure, the half-yearly disclosure, will form the main basis for the statutory auditor to give his comments even on Karo. Because when you're referring to 177 compliance and 188 compliance, while LODR goes one beyond, it will be necessary to take a look at this also. When you're referring to 177 compliance, broadly, it is every transaction with a related party requires audit committee approval. The proviso says that if it is a transaction in the ordinary course of business and on arm's length basis, Section 188 proviso says Section 188 will not apply, which means you don't require shareholders' approval, you don't require board's approval. But 177, as I was saying, audit committee approval will necessarily be required. Now, audit committee also has the right to grant what is called an omnibus approval. If a transaction is repetitive in nature, and the and it is one which is reasonable, which is likely to be happening regularly, the audit committee may grant an omnibus approval, which is what you were referring to. So what is an omnibus approval and what can it be distinguished from? An omnibus approval is one where you grant an overall limit with respect to each of the parties, not going into specific transaction level detail. The micro details are not necessarily given. And as opposed to an omnibus approval, you would have a specific approval for a specific transaction. For example, a long-term contract with a named party for getting a specific service would be a specific contract, a long-term specific contract. For example, let's take this hotel. Maybe they have a long-term contract for maintenance of the premises. So if it's for maintenance of the premises, where they pay, let's say, a fixed sum on a yearly basis to a particular party for, let's say, a 10-year period. Now, the hotel, the shell structure of the hotel may be owned by one company, and they may have entered into an agreement with another company for management of the hotel, which for which they would be paying, let's say, a fixed sum. It could be a fixed sum. It could be a share of profit, which would have been defined by way of a percentage. Whichever way be it, it would then be said to be a specific contract for a specific tenure, as opposed to an omnibus one. An omnibus agreement is one where you know the name of the party, you know as to the general nature of transaction, but the quantum and other details are not known. Say, for example, it could be with respect to purchase of goods, or it could be on a regular basis where you're going to be purchasing, where the price is not a fixed price that you're aware of. Let's say, for example, depending on your demand, you're going to be taking or having an offtake from the other company, and the other company is a related party, so therefore you would be taking an omnibus approval. But for omnibus approval also, it is necessary to specify a limit for the entire class of omnibus approvals. That is, let's say you have related party transactions with 20 entities, then for what is the policy of the company? What is the maximum percentage up to which they would have related party transactions? It could be X percentage of turnover of the company concerned. Then, with respect to each of the parties, what is the monetary ceiling? This is exactly the ceiling which I was referring to a little while ago in the context of 23(9), the statement which is required to be filed with the stock exchanges on a half-yearly basis. You're required to mention the limit which has been approved by the audit committee. So in case of an omnibus approval, you would be mentioning the party-wise limit which has been approved by the audit committee. And if it is a specific contract, you would have yearly figures which has been approved. Now, it's quite possible in a specific contract, you may not have the figures. It may have been approved on the basis of a particular basis. Let's say, for example, 10% of the top line is required to be paid as charges. Then the top line is a figure which keeps changing. Of course, the agreement would say that you would be ascertaining based on quarter basis. Payment lag would be 1 month, 30 days, 20 days, whatever be it. So based on that, you would be ascertaining, and that is something which has been already approved. The money amount has not been approved, but the basis of calculation has already been approved. And based on that historical data also, you would be able to ascertain as to how much the company would be incurring on the basis which has been agreed with the other party. So that is what will be required to be disclosed in your 23(9) statement. Any doubts on this? Okay, change in the ownership. So fine. Can you just elaborate? Sure. Can you just elaborate a little further? Let's say, for example, there's a company which has Mr. A, B, C, D as 4 directors. Now there's a change in management. All have gone. So your related parties have shifted. Let's assume you now have A1, B1, C1, D1. So on the date when you're disclosing, on 30th of September, if these persons are not your related parties, you would not be disclosing. And if with the related parties, the entire category, you've not had transactions exceeding 1,000 crores, you would not have gone to the shareholders, nor are you required to go to the shareholders. So for an omnibus approval, you need to have a named party and a limit. So if you're not sure as to who you're going to be dealing with, you cannot take an approval saying any party. What you can do is take limits for 3-4 entities, saying that A, B, C, D, subject to a maximum limit of 20 crores or whatever be the figure. Okay. And then you know that this 20 can be spread across all 4-3 as the case may be. Or better still, have all 4 names and have limits put against it. You decide not to transact with one of the parties, no problem. At least you have the limit. It's an enabling provision. So basically what you're saying is if there is a scheme, for each scheme you would have a separate trust. Is that what you're saying? Okay. So you may not know as to which scheme you would be floating, but the asset management company is the company which is actually going to be doing the transaction. So would you be having transaction directly with the trust or with the asset management company? Okay. Okay. So at what frequency do you form these trusts? 3, 4 in a quarter. This is what an ARC. Okay. Sure. So uh, let's look at a situation where you formed a trust. Okay. Now, will this trust be a related party is the moot question that you'll need to see. Okay. How do you say that the trust is a related party? Who's the trustee of the trust? Because under LODR also, in case of REIT and InvIT, they said all the compliances will be done by the investment manager. So here, you would anyways have an asset reconstruction company, I mean an ARC, or even in case of a asset management company, as the case may be. That entity, you can and that entity will definitely be a related party. So you provide for an enabling resolution with respect to transaction with that particular entity. But my question is, will the trust be a related party? Who would be the trustees of the trust? Sure, sure. We'll have a separate discussion. Sure, we'll discuss separately. That's pretty interesting, I would say. Okay. So coming back to the point of related party transactions, once again, I think broadly, most of the areas which are covered have been addressed. There's one major point in Regulation 23. In fact, that's a mistaken interpretation which is there among a few people, that there's a clear exemption for transaction between two wholly owned subsidiaries. Now, there is an exemption in LODR for transactions between an entity and a wholly owned subsidiary, or a transaction between two wholly owned subsidiaries. That's only from an approval perspective that there is an exemption. For this 23(9), that is the statement which is required to be filed with the stock exchanges, there's no exemption for transactions between two wholly owned subsidiaries. There's an exemption for transaction between the wholly owned subsidiary and its holding company. There is an exemption because the format says where it is fully consolidated, you don't have to disclose. But transactions of two wholly owned subsidiaries, there is no exemption, and you're required to make disclosure in your statement. In fact, if you see, I've been repeatedly saying this is required to be disclosed, that is required to be disclosed. If you see companies which have made this disclosure, you would find that the number of line items have gone up, maybe from about 60, 70 to around 600, 700. There are few companies who have already had around 2,000 entries also. And mind you, all this is required to be done on the same day of the board meeting, once come 1st of April. So after 1st of April 2023, it's going to be quite a lot of compliances. The next one, which is also very, very important, is currently it is 10% of the consolidated turnover, which is used as a threshold for seeking approval of the audit committee. After 1st of April 2023, with respect to subsidiaries, transaction of subsidiaries where the listed entity is not a party, this threshold of 20% is coming down to this threshold of 10% of consolidated turnover, not 20%, 10% of consolidated turnover is coming down to 10% of standalone turnover of the subsidiary concern. Let me repeat. Currently, if a listed entity has subsidiaries and the listed entity is not a party to the transaction, with only the subsidiaries being party to the transaction, then approval of the audit committee of the listed entity is required only if the transaction exceeds 10% of the consolidated turnover of the listed entity concerned. This is the law presently. From 1st of April 2023, if the listed entity is not a party to the transaction and any of its subsidiaries is a party to a related party transaction, then approval of the audit committee of the listed entity will be required if the transaction exceeds 10% of the standalone turnover of the subsidiary concerned. Let me put some figures. Let's assume the listed entity has a consolidated turnover of 15,000. Subsidiary has a standalone turnover of 1 crore. 15,000 crores consolidated, 1 crore standalone. And this subsidiary, which has a standalone turnover of 1 crore, executes a transaction, or rather is intending to execute a transaction of 11 lakhs with one of the directors of another subsidiary, or a private company in which one of the directors of another subsidiary is a member, then approval of the audit committee of the main listed entity will be required. I repeat, listed entity consolidated turnover 15,000 crores, one subsidiary turnover of 1 crore, and of course this 1 crore could even have been 1 lakh. 1 crore turnover, and there is a transaction of 11 lakhs between one of the unlisted subsidiaries with a private limited company in which one of the directors of another subsidiary with a turnover of possibly 20,000 is a member, then this transaction of 11 lakhs will require approval of the audit committee of the listed entity. Let us now try to unravel this mystery and see. Let's assume a company has 10 subsidiaries. One subsidiary has a turnover of 20,000 rupees. And on this subsidiary, you have 3 directors, and one of them has maybe his sister, who is a member in a private limited company holding 1 share. That private limited company has outsiders who are, maybe that sisters, joint family, the other members of the family actually have that business. Then that private limited company, which is professionally known in the market, is entering into this transaction with another subsidiary of 11 lakhs. How is the holding company going to map and get to know these details before the transaction is entered into for the holding company's audit committee to approve such a transaction? This was, of course, a triviality that I raised, but let's now go into a more serious one. Let's assume the company in India, which is the holding company, has a subsidiary in London, and the London subsidiary contributes to 80% of the top line of the Indian company. Now, this London company, obviously the London subsidiary, while it's a subsidiary, it's much bigger than its own parent. And the Indian company is going to tell the subsidiary, you can't do anything. Of course, if it's 80%, then everything that it does will be more than 10% of consolidated. But, today it may not necessarily be more than 10% of consolidated. But having said that, anything which is big there, you will have to tell the subsidiary in London that you cannot proceed with the transaction until our audit committee has approved your transaction. Right? And that's the law today. We have to be very, very careful about putting systems in place and ensuring that the transactions are all properly monitored. Of course, SAP systems have become the order of the day, and every entity has a properly managed ERP which is in place. But gone are the days where one could do some business with Tally, and especially if it's a listed entity, then all these complications and complexities have to be thought of. And it is not just equity listed, even debenture listed, high value debt listed entities. I mean, there are a lot of private limited companies which have listed their debentures, and high value debt listed, the threshold is just 500 crores. And 500 crores in today's situation, as you all are aware, it is not a very big sum at all. So 500 crores, one needs to ensure that you are completely in compliance with the provisions of LODR. So high value debt listed is treated virtually at par with equity listed for the purpose of all corporate governance requirements, and related party is one such provision. Let me give you another example. Let's say, take the case of a private limited company which has debentures listed on the stock exchange. As you're aware, with respect to high value debt listed entities, up to 31st of March 2023, it's a comply or explain mode, which is just another few days now. And post that, it will become a mandatory provision. Related party transactions are applicable to all high value debt listed entities. Private company with, let's say, 4 members. Let me take it beyond 2. 4 members are 4 persons of the same family. Father, father's brother, one son, and brother's son are the 4 members who are members of this particular private company, which is debentures of, let's say, 1,000 crores private company, and they have a related party transaction with one of the companies in which they all 4 are one of the private companies in which all 4 are members. Now, no related party can vote on this transaction. What do they do about it? How do they get this resolution passed? The only option is, up to 31st of March, they would have to say that all members are members in the other entity also, and hence it's impossible to comply with it. So comply or explain. Even if they want to comply, they cannot comply. So they will only have to put this comment. Maybe from 1st of April, there may be a relaxation similar to what has been provided in Companies Act, where in section 188, which says that if 90% or above of the members are the same, then are interested in a related party transaction, then they'll be entitled to vote. They'll only have to give their disclosure. For that matter, even in case of private companies, the related parties are entitled to vote. Even the board of directors, they only need to disclose their interest. Thereafter, they are entitled to vote. Private companies, that's because private companies, it is believed that it's a smaller group. So once you have disclosed their interest, they can do it. Similarly, at a general meeting, there is no concept of the related party not voting unless the related party is one who's related to that particular transaction. And in any case, the 90% limit will enable people to vote, because if 90% is the same, then it is only for shareholders' protection, and they are anyways protected, is a reasonable assumption to make. Under 177, there's another provision which says that if the audit committee does not approve a transaction which is not covered in 188, then the audit committee has to give its recommendation to the board. This proviso needs to be dissected further. It says the audit committee does not approve a transaction which is not covered. The audit committee does not approve a transaction with respect to a transaction not covered in 188. Now, 188, as I said, has certain types of transactions: purchase and sale of goods, purchase and sale of assets, underwriting, office or place of profit, or the like. If it is not relating to any of those and the audit committee does not approve, then the audit committee has to give its recommendations as to whether it is in agreement, why it is not in agreement, what are the reservations the audit committee has, and place it before the board. Which means the board will have the ultimate say in the matter, even where the audit committee has not approved. Let us assume the board considers the matter and does not approve the related party transaction, then the matter sets at rest. Board has also disapproved, the issue is closed. But let's assume the board has approved the transaction. Then the company will be entitled to proceed with the transaction. However, remember, in the director's report, there is one specific provision which says that if there are any matters which the company has proceeded with without accepting the recommendation of the audit committee, whether all the recommendations of the audit committee were agreed to by the company or whether there was any overturning of the decision, in that case, with respect to related party, this particular provision will need to be covered, saying that the audit committee had recommended against, however, the board had recommended for. My personal advice here would be where the board proposes to approve, the board obviously will comprise of all the audit committee members plus some more. So in such an event, one should use the power which is generally used by the revenue authorities of remanding the matter back, where you've discussed the whole issue and you remand the matter back to the audit committee, saying that in the light of these points, the audit committee may once again consider the matter before it is brought up before the board, so as to ensure that you don't show this conflict between the two entities, unless two bodies, unless at the board also the audit committee takes a differing view. Audit committee members take a differing view, but the board decides to go ahead with it. That's also possible, in which case you cannot ask the audit committee to once again reconsider. But I'm sure this would also raise a basic question. If the audit committee has decided not to go ahead with the transaction, why would they approve when it comes up before the board? Let me pause and ask for the answer from you all. The audit committee had considered a particular matter and they did not agree to it. But subsequently, when it comes up before the board, the audit committee members, all of them unanimously agree to the particular proposal. Is this possible at all? If yes, why? Absolutely right. Absolutely. Maybe some points which were factual were not properly placed before the audit committee. Maybe some of the points which were placed were not properly understood in the context in which one would understand. Maybe, let's say, for example, arm's length pricing. The audit committee would have decided not to go ahead, presuming that it's not an arm's length pricing because there are three other parties who are known to be supplying in the market at much cheaper prices. So they may have gone purely on pricing rather than arm's length basis. And when the matter comes up before the board members, it's quite possible that only independent directors are members of the audit committee, and therefore they did not know about this. When it, of course, ideally, they should have called the persons concerned, took the details before deciding on the matter. But assuming that they had not, when it comes up before the board therefore explains as to what these facts are. Maybe those three parties who are supplying at a cheaper price have been blacklisted because their quality has not been consistent. Maybe those three parties have prolonged litigation with few other parties. Maybe those three parties are not financially very sound. So all these facts may not have been known to the audit committee. That's a genuine case where they may agree. But otherwise, if the audit committee sticks to its stand and says, we are not in agreement, then you cannot remand the matter back to them also, but you will go ahead, but ensure that the company has made a disclosure in a director's report clearly stating that this was one issue where the company did not go by the recommendation of the audit committee. What is also important is wherever there are these differences, it is very important to give a further explanation. Otherwise, it's going to create a negative feeling. If you just factually state that there was a difference without stating as to why the difference was there and why the board feels it's in the interest of the company to be approving such a transaction. It's quite possible. Legally, it is not required to explain. But if you have not explained, you've economized on truth. And therefore, it will lead to more assumptions being made by the reader. Ensure that it is not made. Ordinary course of business is not a defined term. How do you determine what's in the ordinary course of business? Does it require a clause in the memorandum for something to be determined to be in the ordinary course of business and on arm's length basis? Ordinary course, let's say, for example, in a place like Australia, there is guidance very clearly given as to what is ordinary course. I personally hold this view that it's good that it has not been oversimplified, because what is in the ordinary course is something which is left to the circumstances. For example, if a small company were to be doing road transportation, it does not require an aeroplane to have this transportation business being carried on by it. But a courier company, let's say, for example, Blue Dart, has several aircrafts because they want to ensure that the logistics is properly controlled so as to be able to deliver their goods in the right time. They provide their services in a timely manner. And this is very much required because they've grown in size. So what is ordinary course for them will not be ordinary course in another case. So based on the facts of the case, if you're going to be changing, you cannot have a straight-jacketed law which says that this is what is ordinary course and this is not. What you can do is possibly have guidelines to test it, but it's best left to the businesses because business is dynamic and it keeps changing as we go along. Broadly, I've covered the different aspects and I'll be happy to take on questions so that we devote another 15-20 minutes for questions. What about GAR? So from a GAR perspective, you would be ensuring that it is in compliance with your transfer pricing and other requirements. If that is taken care of, it's fine. Further questions? Transfer pricing. Absolutely. Transfer pricing cup method is a very well settled way of determining that it's on arm's length basis. So although under Companies Act, the word used is arm's length basis. And under transfer pricing, it's only price which is used. So there could be something more than price which is required to justify arm's length basis. Having said that, anything which is quantitative always affords an easy comparison. So therefore, arm's length basis is very often used in the context of arm's length pricing. And when you talk of arm's length pricing, the 6 methods in Income Tax Act is what is very, very commonly used, and cup being the one which is most popular. Because it affords a very easy comparison if it's cup method. The auditor. So the government will only come into play if there is some investigation. And the auditor, of course, it was also there in Caro 16, which is also there in Caro 20, where para 13, 3113 requires the auditors to very clearly state as to whether the company is in compliance of section 177 and 188. And 188, one of the ingredients is arm's length basis. So this, when you're certifying, of course, different auditors have used different styles. There are 3 broad styles which have been used. One is to have a simple statement which says the company is in compliance with section 177 and 188 with respect to related party transactions. The second one is slightly guarded where it says in our opinion and to the best of our knowledge and belief, the company is in compliance. The third one says on an examination, on the basis of the information provided to us, and on a verification of the records, we state that, or we are of the opinion that the company is. So on the basis of information provided gives you one level, but at the same time, as an auditor, you are supposed to have seen the list of related parties. You're supposed to have seen the ledger of those related parties by doing a random check. If the number of parties are too many, now with computerized the sample checking concept itself has got diluted. You can just put the filters and ensure that you get one single report of exceptions in a matter of no time, and that will become your working paper. So this is what you will have to justify, saying these are the details that you've seen. Plus, added to all this, you also have the internet where things are available in public domain. So based on which, once again, like say for example, if it is with respect to a complaint which has been filed by one of the directors alleging something, you're supposed to be seeing and going into a little more details, which is the reason all the auditors nowadays also have discussions, rounds of discussion with the companies concerned and the executives of the company. So this is the methodology that you will have to do so as to justify that there is reason for you to come to a particular opinion. Yeah. Yes, please. Right. But my auditor is not inside foundation. So actually, small companies, while we say that they are small companies and it is only family owned, they do have exposure in terms of bank loans. So no, there is nothing, which is exactly the reason why they're not exempted also. So for example, if you refer to Caro applicability, Caro applicability does have loans from, yeah. So actually, slowly and gradually, the government is bringing in this concept of loans. For example, even with respect to independent directors, it refers to loan from banks and financial institutions of 50 crores or above. So internal audit, independent directors, Caro, the threshold is so low. That's mainly because they want to ensure that governance per se is brought in. So if you choose a company form of organization, you would be required to comply with disclosure requirements. Now, actually, I would say that the transparency is by ensuring disclosure. And on the second level, it is approval. Now, with respect to approval matrix, there has been a relaxation which has been given, mainly because it is the same set of people who are the directors, shareholders, family members, small company. And that particular concept has come in the approval mechanism. But disclosure, all entities which are companies, disclosure is going to be fairly uniform. For that matter, if you refer to Schedule 3, it's a it's a very, very complex and complicated one, and and Schedule 3 and Caro have now become very, very closely related. And everything which is given in Schedule 3, I mean, if one were to actually do a proper reading of Schedule 3, read with the Caro report, a bank will get everything that it wants at one go. So, but your point is, if there is no borrowing and it's only a mom and pop company, why should there be so much of disclosure? That's because you're presuming that they will never want to go for a borrowing. That's right. So actually, I personally hold this view that disclosure is necessary. And I also hold this view because most disputes which have gone to NCLT, originally CLB, are all with respect to small companies and private companies only. Because of, the family members, so long as everything is okay, there's no problem. But the day there is a dispute, they say that I was never invited for the meeting. I was never told that there were transactions. One brother is giving, no, signing authority may be with the eldest brother, and he may be giving money only to one faction of the family. One person unfortunately passes away and everything comes out in the open. So it's disclosure is most important. I mean, there are a good number of case laws as to why some of these small businesses did not really grow. And that's exactly the reason disclosure is required, so that there's no allegation subsequently made. And if they've signed the annual report, so be it. That's the end of it. So if disclosure is there and they have signed, nobody can take any further shield. Unfortunately, what happens is the auditor ends up doing most of this, while the accounts should have been ready for the auditor to audit. It's the other way around. Yeah, that's true. Yes, please. You had another question. Yeah. Any further questions? Yes, please. Listed company or unlisted? 1,000 crores. Consolidated. Absolutely. Yeah. Yeah. Standalone is only for audit committee approval from 1st of April 2023. Shareholders, it's the same limit, 10% of consol or 1,000 crore, whichever is lower. That's correct. Absolutely. Absolutely. Yeah. So in fact, audit committee, the term which I have done for this is independent. In fact, I just discussed about an audit committee with 5 directors, 3 independent directors and 2 non-independent, where 1 independent director is absent and 2 independent directors approve it and 2 non-independent directors do not approve it. So the resolution, in my opinion, is not passed. But if you were to technically look at it from a LODR perspective, it is actually passed. Yes, please. Sure. So I would give you answer in two parts. The first one is simple in one line or rather one word, everything. Second, let me elaborate a little more. First, of course, you need to know about the business of the entity as to what is happening in that industry generally, which in any case most directors do. Second, in terms of practices and the litigation, the kind of cases that they've been facing, if any, which you will get to know even from the annual return of the company. So getting a reading of the last 3 years annual return, even if it's an unlisted company, you will need to do that last 3 years balance sheet, especially the notes, just to see whether they are generally in compliance. See, it's not necessary for the independent director to become an accountant or a company secretary or a lawyer, but he needs to understand as to where the company is mainly on compliances. Because by joining a wrong company, the independent director should not get disqualified. And therefore, that is the first thing that he needs to be assured of. Second is, it should not be a company which is likely to turn into an NPA, because if it turns into an NPA, then subsequently it may go into CIRP and IBC, and the director concerned should not run into a bit of a problem, because if the director is on the board of a company which has gone in for CIRP, there are disclosures which are required then. So those things are the broad ones. And the next one is to see as to how the practices are. The company may be incurring losses, but may have a genuine good business, well run. It may just be a cyclical thing, or it might just be the gestation period. You can't expect profits to come in the first 2 years if the business is one where it's only likely to come after 5 years. Say, for example, if it's a pharma product where the product has tested well. Let's take the case of vaccines. Once it started doing well, we knew that it was only an upside. And, who knows, after the booster, there may be a booster to the booster and so on. So with respect to these, when they started initially on research, of course, the company was anyways very sound and doing well, but there could have been several others also who may have done the research. So, one needs to see as to the fitment with respect to these. Today, it is not very essential to have domain expertise of the company on the board of which you're going to be sitting. It is necessary to have lateral thinking, to be able to think differently, bring in the experience. Sometimes, the board may have very young board members who absolutely are mavericks and can think differently. So you need to have a proper mix. On such a board, it is necessary to also have people who are going to be raising few questions. That doesn't mean that the person is not going to approve, but it is necessary to raise the questions inside the boardroom than be raised outside. And practices of the company with respect to, basic things, disclosure, the policy with respect to related party transactions, what is the succession planning generally, whatever is seen and known about the company. And based on that, you take a call. So actually, even before you join the company, you must have 1 or 2 rounds of discussions to find out a little more about the company. And also, when you meet, see, figures speak a lot. But unless and until you talk to the person, you don't get to know the belief of the person. And that's what is more important today. Like, say, for example, another point which is important today is on ESG, climate. What is the general approach with respect to the business of the entity concerned on climate-related issues? What is the product life cycle? How exactly is the disposal being taken care of? And so on and so forth. All these also become important because that is the way they're going to be using their money to spend. For example, if you were to look at the 70s, way back in the early 70s and I would say early 80s also, the textile industry was doing very well in India. But modernization was a big question, because of which they then started losing to some of the other countries outside. Of course, they had other issues also, but more than that, the ones which modernized in good time have managed to stand the test of time. At the same time, because of the uh, chlorofluorocarbon phasing out, chemical industry, it was a adversity. I'm sorry, it was an adversity, but it led to growth in the chemical industry in India because of this. So you did have those small pockets. But having said that, how exactly do you see as to whether it's a sustained business and how exactly it is doing? Sometimes the business may be making losses, but it may be one which is well run and is likely to see a good period later. It's not about the technology of the business. Let's say, for example, if it was a pager company, nobody would have thought that the company would not really be there. I mean, the product obsolescence happened so fast. Would it have been wrong to join such a company? Answer is no. Or for that matter, even take the case of Kodak. Digital cannibalized their business so completely that they just stopped existing. And it's very ironical that one of their own engineers had thought of this as a good invention at one time. So, but those are technical, completely technical, which is not necessary for every director to be looking at. And of course, anything which is new, one does find a lot more of challenge in it. But having said that, one would need to see as to what exactly is being done, what are the processes generally. And of course, figures would help you understand and as to whether the figures are sustained and whether it is in sync with it. Let's say, for example, if the company has borrowed funds, how exactly, even seeing the feasibility report may give a general idea. Maybe they would not want to share it. At least get to understand by talking, for half an hour, not with the bankers, but with the company board concerned. By just talking to people, you do get to know the level of confidence, the level of engagement in the business that they are into. If a person is completely passionate about it, it's quite possible he would attract others. Yeah. Yeah. That you are actually 4% of your turnover. So, point number one, check your omnibus approval policy, related party policy, whether there's any turnover percentage given in that at all or not. If you have given, then you're in violation of your policy. Please amend the policy today itself. Okay. Post that, you can always respond to the exchange saying that this is what determines your turnover, and hence the turnover is not a fixed sum, which is not clearly identifiable at the beginning of the year. And while there are related party transactions, this is the way in which the transactions are done. Audit committee has considered it. But then there's an NBFC regulation where turnover this is given. True. Okay. So you mean the top line is pretty high, but at the same time, the earning is true. True. There's no accounting standard with respect to this? Okay, okay. In fact, Schedule 3 also was amended with respect to NBFCs, but I think it still is. Sure, there's a note being made of this. Any further questions? Yeah. 10% of the standalone? Yeah. So newly formed entity, if it has been formed after 1st of Jan 2000, let's say 2022, okay, then up to 31st of March 2022, the turnover of this particular subsidiary would be considered while looking while reckoning the 10% standalone limit. Are you referring to this, or are you referring to in the context of LODR, right? 10% of the standalone entity. So the listed entity has a turnover of, let's say, 15,000 consolidated turnover, 15,000 crores. This standalone entity, let us say, was incorporated on 1st of Jan 2023. So 3 months turnover you will have, and 10% of that will be considered. Let's say the company itself is incorporated, the subsidiary is incorporated on 1st of May. Okay, then the standalone turnover virtually would be zero, and therefore every transaction will need to go to the audit committee. In any case, under regulation 24, the significant transaction limit of 10%, every transaction would be placed before the audit committee just for noting. It's for information. Here, transactions with this newly formed entity will go to the audit committee for approval. So the listed entity in any case needs to have an audit committee. Regulation 18 is applicable. Within 6 months of listing, you have to get your compliances in place. So you have a listed entity, you will have audit committee of this listed entity. This listed entity has subsidiaries, which based on the transaction value, you will then need to place it before the audit committee of the listed entity. So I didn't get your question right. Can you just repeat once again? Sure. What was the appointed date? You could have taken an appointed date which is 1 year prior to the date of application to NCLT, up to 1 year prior to the date of application to NCLT. And if it is an amalgamation, if let's assume the appointed date is a prospective date, okay, then the standalone turnover of this amalgamated company will be taken as the base. But if it is an appointed date is taken as, let's say, 1st of April 2022, although the effective date is, say, 1st of May 2023, it will date back to 1st of April. And therefore, up to 31st March, whatever turnover of these two companies were there will all get automatically covered. Because let's assume you were to draw up your balance sheet and profit and loss account. Okay, it will be from the appointed date, and you would have a note very clearly stating that effect of merger has been given, and previous year's figures have been recast accordingly. Yeah, fine. Sure.
There, we have to give an information. Now, usually we cannot say that. Generally, what is the purpose? Because eventually, if something is taken to court or something, and then most.
Sure. I would actually address it the other way. We now have the SBO rules in place. So if under the head of control, the company has filed saying that so-and-so persons are in control, although the company's holding may have been by inanimate entities, that is other companies or partnership firms, LLPs, as the case may be. So if the company has filed SBO declaration, which has also been filed by the company in SBO2, then based on that, you will have to give effective control reference. But if no such filing has been done, then it will be fair to presume nil only and take it forward. But that's a very interesting question, I must say. Yeah. shall we close the session? Yeah. Thank you very much. It's really been very enriching. Thank you.
First of all, a very happy Uttarayan Mankar Sankranti to everybody. So I'm CA Vijayata Jaiswal. It gives me extreme pleasure to propose a formal vote of thanks for today's session. Ma'am Parekh has very lucidly explained various aspects of related party transactions and very patiently answered the various queries raised by all our participants. She has given practical insights from her vast experience and really enriched our knowledge levels. I would like to thank you for all for actively participating in today's session. Thanks to the management of Koinur for the excellent arrangements and to the entire team of JB Nagar for organizing the seminar. Request you to carry a loud round of applause as a gesture of our thanks. Thank you very much.